Hi, everybody. Welcome. This is Josh and Jeremy. Just wanted to sign in here a few minutes early. I know there's going to be a bunch of people signing in, and I just wanted to share with you that we've got a action-packed hour ahead of you here at 4 o'clock Mountain Time. We're going to get going. We want to respect your time as we know that everybody's busy. Everybody's life is crazy right now. I don't think 2020 will go down as being a year that many of us will ever forget in our lifetimes. And so there's some good things beyond that. There's a few things that I think that we've been able to be grateful for, some times that we've been able to have with family, maybe some things that we've been able to recognize that are really important that we didn't before. So we're going to talk about money today, though, and certainly money is an important part of our lives, not the most important thing, but we definitely want to emphasize what you can do around your financial planning and wealth management. So before we get started, a couple of housekeeping items. One of those is that there's a way to ask questions. It's kind of a low tech way, old school way, but that's what our compliance folks say that we need to use, and that's by emailing. And you'll email Jeremy at keystonefinancial.com here along the way. Feel free just to fire questions off as we go through the presentation, and certainly Jeremy will moderate. Depending on how time will go along the way, we'll definitely want to make sure that we keep to our hour. We want to keep that commitment to you that even with the Q&A, we want to be ending at 5 o'clock Mountain Time. So I just want to share that with you, that we will respect your time because we know that you could be doing a lot of other things right now. So with that in mind, we'll give people a couple more minutes here and then we will get started. This is the time that Jeremy and I tell jokes, I think, as we get started, right? Yeah, do you have any, Jeremy? We'll try to inject some humor today. We want to make sure that we're enjoying each other's time too. We will do our best not to make this a dry financial presentation.
Yeah, absolutely. It is actually good to see a bunch of names popping in on the webinar here today. We wish we could all be in person, of course. We miss seeing everybody face to face, but we got to do what we got to do. But thankfully for technology, we have some flexibility with that, right?
Yeah, absolutely. And certainly we would much rather be at a brewery or at a wherever. We've had these in a lot of different locations. I think this is the only time that we've actually never done it in a physical location. So we always try to be creative and think of some place that would be fun to get together, make it a little bit of a social event, but clearly it's not a good time to be social with a bunch of people in a room. I think last year might have been our biggest one. I think we had over 100 people between our clients and some of their friends that had joined us. So thank you for everybody who's signing in. You can see a bunch of people popping in. You can see Ann and Barb and Bill and Doug. Glad you guys could make it. Our very own Gail Perkins, George and Jim and Jeff, John, Ken, Lee, Paul, York, Tony, Wayne, Bill. I can still see people coming in. Glad you guys are able to join us today. So thanks for taking the time. Certainly, we'll give people just another minute or so here, and then we will get started. As I mentioned before, for questions today, you'll definitely want to make sure that you use the low-tech questions feature, and that's by emailing Jeremy at keystonefinancial.com. That's kind of our low-tech way that our compliance folks say that we need to use that. So we're going to honor that and use uh, that very old tool of email that will work just fine. We'll compile the questions and make sure that everybody's able to get their questions answered along the way. For those of you who are not tuning in live, feel free to ask us questions anyway. After the presentation, if you're going through, feel free to jot some stuff down. And if you don't get your questions answered, please just email us directly. We make ourselves very available. Josh at keystonefinancial.com, Jeremy at keystonefinancial.com. What time you got, Jeremy?
I've got 3:59.
All right, sounds good. We'll give people just a second here to sign in. You can still see some folks popping in. So for those of you who are still signing in right now, welcome.
And that is 4 o'clock.
All right, sounds good. So officially wanted to welcome everybody now that we're hitting 4 o'clock. The one thing I definitely want to make sure that everybody is aware of is you've got an opportunity to ask questions today. This isn't just Jeremy and I talking at you. Certainly, we don't want it to be that. I know you're here for our insight, certainly, but there's an added benefit of being here live and you can ask us questions. And not only that, but you can benefit from other people's questions along the way. So please take advantage of that. If we start getting a little bit long on time, what we'll do is we'll compile the questions and maybe hit them at the end. And some of them we may not do word for word. If Jeremy is catching a theme that, hey, three people have the same question, essentially, we'll go ahead and hit that. But certainly throw those at us along the way. We definitely want to be able to share that with you, share you what our thoughts are, not just us, but we interact with a lot of different experts across the financial industry. When you think about the big institutions that we're affiliated with, like Fidelity, these are big institutions that have a lot of resources and a lot of wisdom as well to be able to share with us. We also do a lot of reading on our own, a lot of research that we get from outside organizations. So we definitely want you to take advantage of that because we do spend a lot of time trying to pull together useful information. Financial planning is kind of an art and a science. There's a little bit of both that's built into it. And even the world of investing, you would think, well, that's got to just be science. No, there's a lot of emotion involved and a lot of art in creating portfolios. So certainly we want to make sure that as we're interacting with you, we're really giving you the best tools that we possibly can. And ultimately, you make your own decisions. We all do, right, financially. But we definitely want to be mindful of the fact that the more advice that we can give you based off of not just our thoughts, but also the experts and people who are older and grayer than we are that have been around this industry for many years, like Warren Buffett, I think is 89 years old right now. We pay a lot of attention to Warren and a lot of attention to many people that have come after him as well that really were his students. So with that in mind, again, Jeremy at keystonefinancial.com for questions. We're going to hit a few different topics today. We're going to keep it concise enough that we leave question time at the end. So we'll definitely try to catch them along the way, but if we're not catching your question, don't think it's not being answered. We may actually catch it at the end once we're done with the actual presentation. So I mentioned before, we like to get together in person with our clients. So I'm sure we're all kind of in the same place, right? We're all getting cabin fever a bit in that we like to be social and get out and do stuff and see each other. So I'm glad that you all tuned in. We get to visit with a lot of you on Zoom calls and go to meeting calls and phone calls. Different ways that we're able to interact with you with the circumstances that we're all under, but certainly we'll look forward to the day, hopefully 2021, this will be a live in-person event someplace that we can enjoy each other's time and company. So thanks for being here today. Couple of introductory comments. Myself, Josh Nelson, certified financial planner, and then Jeremy Bush is our senior wealth advisor. We do also want to make sure that you see our disclosures, which were written by some really smart attorneys, I bet. But those disclosures do cover a couple of different things that are important. Number one, and most importantly, is that everything we talk about today is really just our opinions, of the two of us. It's based off of everything that we're reading, everything that we believe. Of course, we're telling you the truth, but we always want to make sure that you know that it's just our opinions. And if somebody kind of missed it along the way, there's nobody that can guarantee the market. There's nobody that can guarantee that you won't lose money in investments. So just really important to think about that when you're managing money and learning about stuff. Everything really is just your own decisions. And of course, we can't make any guarantees. So with that in mind, we'll kind of pop on from there. Today we're going to cover a few different areas again, and it might seem like some of what we're going through fairly quickly. So again, stop us if you want us to go through some stuff in particular. We'll definitely slow down and go through that. But first thing is the second quarter summary. Really, we gave a bunch of presentations earlier on in the year, probably ad nauseum, and we put a bunch of them out there on our YouTube channel as far as what happened during the first quarter. And of course, it was a great quarter, from the market up until coronavirus. And at the end of February, early March, really everything hit the fan. It was clear that this was going to become a very big deal. And really, that's when the talk of shutdown and lockdowns and everything started up. Massive losses in the stock market. So the first quarter was quite eventful, both up and down. We're really going to focus on second quarter, more recent stuff, because I think a lot of people are well aware of what happened in the spring. We really want to talk about more recent stuff and also the economic environment that we're in. We really want to talk about what we're seeing and what the experts are seeing about the economy and where it might be going in the future. Fundamental insights, really just some thoughts that, again, a lot of experts have about what's going on in the world and really what might impact your money in the markets. And then, finally, risk analysis. We'll be talking about some of the risks that are out there. And of course, there are a lot of them that are out there, especially coronavirus, but that's not the only one. Certainly, there are a lot of things that could go wrong. And certainly, this has been a year where a lot of things have gone not the way that we would have liked, that we would have preferred. So, my market forecast, Jeremy's market forecast, when we got up and spoke and gave our webinar back in January, we certainly didn't predict any of this, but the good news is nobody else did either. So, we're certainly victims of the world and what's going on. And I think it's been a very humbling year for any forecasts that were made back in January. So 5 key events. First of all, the reopening of America, in fits and starts, certainly. So the second quarter, there was a lot of crazy stuff that ended up happening, and we've got a few visuals on here as well. We didn't put the visual of the murder hornets in. I mean, how many things could happen back to back, right? What was the other one, Jeremy, we were thinking of the other day that came out?
Well, there's coin shortage and there was Chinese seeds.
Yeah, the
Right?
Chinese seed packets.
That's right.
Yeah, pretty crazy. And I think there's legitimately stuff that's happening, certainly this year, and certainly some really sad things that have happened this year. But I think it also goes to show that there's a lot of sensationalizing things, and the news media is having a heyday with all of this. If you think about what the news media is there for, is it's not to educate, it's not to inform, it's there to sell marketing, it's there to sell advertisements, and they've had a lot to talk about this year. It seems like there's maybe some sensationalizing of a lot of it and a lot of taking advantage of some of these situations. So, certainly it's not to make light of any of the bad stuff that's been happening, but some of it, like the murder hornets, things like that, it seems like they almost have a queue. They have a queue of things that we need to be worried about or scared about. So certainly the reopening of America is happening in fits and starts. I think the conversation that a lot of us are having right now is what's going to look like for school here in a couple of weeks. Are kids going to go back virtual, or are they going to go back in person? Is there going to be some combination of those things? And really, what are the results? Bottom line is nobody knows, whether it's Dr. Fauci or Dr. Birx or any of these experts, clearly nobody really knows. They're all giving their opinion and what they think, but nobody really knows as we've been feeling our way through this. And of course, there has been a virus resurgence that's hit. Seems like it's starting to wane in some of the southern states right now that we're getting hit. So some of those numbers are improving, but that doesn't mean that there won't be another resurgence and another resurgence. And the more we're learning, it seems like that's probably the case, is that coronavirus isn't going to be something that just disappears anytime soon, even with a vaccine, even if we got a vaccine next month. And we're probably not going to get that. I'm sure it's not going to come nearly as soon as we all would like to have it come. But really, I think it's important to just recognize that that risk is here. And the good news around it is that they're getting a lot better. The statistics are really good. I think is that they're getting a lot better as far as the treatment of people that do get coronavirus, that there are a lot better treatment options. The doctors certainly have a lot more experience and a lot more knowledge now of what types of therapies have ended up helping people not only not have as much damage, but not pass away. I think the death rates have gone way down from it. So not to minimize it at all, anybody who's been impacted by it or has had a family member impacted by it, but it seems like some of it, even living with the virus, we're learning to live with the virus and to get the economy going again. Black Lives Matter, of course, major thing. Certainly some tragic stuff that happened earlier this year. And so a lot of protests that resulted from that, a lot of destruction, and none of this is political statements at all. Jeremy and I are not going to get into that. I'm sure you can hear that from plenty of other places right now. But, it certainly has been something that has had an impact not only in the US, but around the world. Lots of protests, lots of change, certainly as far as how organizations function and really some of the choices that they're making going forward. Hong Kong, that's a huge story that I think almost has gotten downplayed just because of all the other stuff that's been happening. But the treaty that China had signed with Great Britain back in the 90s to give Hong Kong back to China and let it basically be a free country and act autonomously, that now is kind of gone by the wayside, and many countries now are kind of grappling with how are they going to approach Hong Kong and China now as a result of the crackdown. Some countries are even talking, Great Britain and the US are actually talking about opening up visas really for any Hong Kongers that want to leave and come here. And there's a highly educated workforce and could be actually a real positive thing. But certainly a huge financial center that effectively is never going to be the same again at this point. And certainly other countries will not view them the same either. Government action, of course, the government, to their credit, I think, not that they did it perfectly, but the government, both fiscally and monetarily, jumped in really quickly back in the first quarter when it was evident how bad the coronavirus impact was going to be. The Federal Reserve jumped in and acted actually even much quicker than they did back in the financial crisis in 08, 09. And then certainly it's a bright spot. Maybe it was just temporary, but a bright spot. The president and Congress got along really well and came up with some legislation that ended up printing a bunch of cash or putting a lot of cash back in people's pockets. And that to a large extent, that has been where we've seen some economic rebound. And many economists now are saying we're actually out of the recession because it does take two negative quarters in a row of negative GDP. We bounced off some of those levels, and we'll talk about that in a bit. But certainly the government action was a huge part of the story. So looking at the second quarter in 2020 performance, we saw a huge resurgence, and it was really a really tough first quarter that we ended up having, but now a 20% increase that we saw in the second quarter. Year-to-date performance still down negative 3.1% as of the time we printed this slide. I think that kind of bounces up and down depending on when you look at the numbers. Certainly we've had a lot of volatility. It was the best quarter since 1998. That we had, and certainly that's not saying a lot because we were down at very low levels. The Dow was down to 18,000-ish at one point, and so some of the losses that we saw were extraordinary in how fast they happened. And certainly the U.S. growth and technology continued to outperform throughout throughout that period of time. So it has been not even as far as the different sectors that have been impacted. And then, reopening seems to benefit value stocks better than growth stocks. I think that's kind of gone back and forth depending on which sectors. Certainly traditional value stocks like financial companies and energy stocks just got crushed, absolutely crushed in the first half of the year. So certainly if we have a full reopening, those will actually benefit. Certainly financial institutions have gotten crunched pretty hard because of a couple of different things. Number one, we've seen really low interest rates, and many of them function well at higher interest rate levels, but also insurance companies. Some of you may have seen the discount on your car insurance premiums, for example, because most of us aren't driving as much as we were before. Certainly that hurts the bottom line with insurance companies.
Yeah, the big thing to take away from this one, I think, Josh, is really like you were saying, the difference between growth and value. And we've always known that growth and value stocks tend to almost move inversely of each other. When one is doing great, the other not. And I think I think just the time frame that we're seeing that happen and roll out this year is we're seeing that time frame on a much more compressed scale, really. And so at the beginning of the year, yeah, it was more value stocks. Growth stocks were struggling a little bit. Everything dropped, of course, middle of February hit. But then since February to now, growth stocks have really taken off, specifically large cap growth stocks, which if you think about it, really makes a lot of sense. The companies that were most impacted by a lot of this are your smaller to mid cap companies. Large companies have the ability to, scale however they need to. They're much more flexible in terms of offering different kinds of services, or all of a sudden shifting and saying, hey, we're going to push our online stuff now instead of our store stuff. And so I think we saw a lot of that. And I think, just like Josh said, probably in the second half of this year, we might see that shift over to where now the value stocks are starting to do their catch up, which is pretty fantastic. I think that'll be great. And even Josh was saying at the beginning, when this was printed, I think the S&P was still down about 3.1%. As of close today, the S&P 500 is only about 80 points off of where it was at its high in February.
Yeah, which is pretty amazing. I think most people would not have expected that, especially during some of those dark days. And believe me, we're human. So during some of those dark days where we were seeing, 4-digit swings, 1,000, 2,000 point swings on the Dow every day, I was getting flashbacks back to the financial crisis where we were wondering, seriously, I would wake up in the fall of 2008 and wonder, well, what bank went broke overnight, or is the financial system still intact? That's how bad things were back in the financial crisis. And so I think some of us were having, getting a little bit of flashbacks with what was happening and wondering, gosh, how bad are things going to get here? Yeah, and you can see a lot of volatility, certainly, kind of jumping onto this slide, a lot of volatility. And I would expect, and we actually did predict that in our forecast, we actually did talk about volatility. And certainly I would expect that we're going to continue to see a lot of volatility throughout the rest of the year because there are risks still there. Really going back to 2009, that was the last time that we had seen so much volatility, so many swings both ways. So I would expect that we're still going to see a lot of volatility through the end of the year. Of course, we have other factors and other things that we don't know. You guys might remember Donald Rumsfeld, and for those of you who are younger, you might not even know what that name is, but he was the Secretary of Defense back during the George W. Bush administration, and he had some famous talk that he had given, was talking about known knowns and known unknowns and unknowns unknowns. And certainly, the things that we don't, the things that are completely out of the blue, that will be like the unknown unknowns, like COVID. Nobody saw that coming, that this would have an impact this year. So there's certainly things like this that just come out of the blue and really nobody can predict. There are other things that we might recognize that it could be a known unknown. In other words, that it's a factor, you just don't know what's going to happen. And certainly, there's plenty of that stuff as well. That at least you can plan for a little bit more.
Indeed. Yeah, a lot of those up and down days. I think everybody felt those 1%, 2% moves on a lot of those days. Luckily for us, I count ourselves very blessed. I would say the vast majority of our clients, I can probably count on one hand the number of people that I had to, take phone calls from that were genuinely concerned about a lot of this stuff, and rightfully so. It's perfectly human to be concerned about a lot of that, but very, very blessed with the clientele that we do have.
Yes, for sure. That's the best part of our business, for sure, is the relationships we get to have. So I'm glad to see so many people are on the call. Even the folks who jumped in late, glad that you're here. And certainly for those of you who watched the recording, we're still glad that you got to join us, and we'll look forward to talking with you live soon.
Absolutely. So yeah, so as far as our current economic environment goes, we're really finding ourselves in this, battle of these two factors. It's reopening and getting the economy back going again versus the virus resurgence. So I think we're maybe find ourselves at kind of the second wave, maybe the beginning of the second wave of this thing happening. We have to remember, when this whole shutdown started, this has never been done before. This is the government coming along and saying, hey, it'd be a great idea. Let's just shut everything down. We'll give it a couple months and then we'll turn it back on. And so everybody said, yeah, let's give it a shot. Why not? And now it got to the point of, okay, we've been waiting for a long time. We really need to open, or this really needs to open, or people need to get out of their houses, or whatever that looks like. And so that has really not gone away. We still find ourselves in that kind of battle between the two. And there's very real economic consequences for that shutdown. Did it serve a purpose? More than likely, yeah. I think it did stem a lot of that virus spread initially, at least. But the issue I think that we're dealing with now is, state by state, there's different cultures of social distancing that exist. I think even within the state, you could pick the state of Colorado itself, and depending on what city you're in, you're going to have the population that views social distancing different from another. Okay, and it's not to say that it's not even to say that necessarily one view is right and one view is wrong. There are people that come from the view that, hey, I am a small business owner. I need my business to reopen in order to survive, right? I can understand that. And then there's definitely the flip side of that I would say is, I need to keep my family as safe as possible, and we're very, very worried about, virus and health concerns, and that's absolutely valid as well. And so we find ourselves in that battle right now, that which is right, how can we maximize our utility of getting things done without taking excessive amount of risks. And then of course, there's an entire side of the population that says, hey, if I get it, I get it.
Younger people.
Unfortunately, that's out there. And I think a lot of what they don't understand is that, yeah, if you get it, you get it. But if you get it, you're probably also passing that on to at least another person, if not more. And so kind of coming to deal with this, and this is kind of our, at least for the time being, until medical advancements happen, that's kind of our new thing that we have to deal with every day.
Yeah, I think that's a good point about the cultures of social distancing too, and just younger people. Of course I'm stereotyping, but younger people, I think don't see it as big of a risk because they see it as something that would only impact them. And of course, they're somewhat right in that if you look at the statistics, if you're under the age of 40, the odds of you dying from coronavirus are really, really, really low. You start getting older and older, and that's really most of the population that's been impacted, that's passed away, has been in the 70s and 80s and 90s. And that's not to minimize that at all, by the way. My parents are in their 70s. I know people in their 80s, 90s that very concerned about, of course, and want to make sure that they're safe. But I think for younger people, they tend to take higher risks anyway. I think as a general population, and yeah, I think that concept, if I get it, I get it, maybe minimizes the fact that a lot of those folks, you may end up getting it, not realize you have it, and end up passing it on because you don't see any symptoms. You go hang out with your parents, your grandparents, other people, and now it gets passed on to them. It gets passed on to them, and we can just see the example earlier on this year, especially in New York. We saw the example of a lot of the healthcare workers in long-term care facilities ended up being the culprit, unintentionally, of course, ended up being the culprit of why many people ended up passing away before more strict precautions were put into place. So, yeah, just a lot of stuff we don't know. A lot of stuff we don't know.
Yeah, absolutely, absolutely. And so, one of the things that we get a lot are questions. People end up surprised, looking at maybe returns or something like that, or how is the market, where it's at right now? How is that even possible with everything going on? What we got to remember is that personal consumption, that is you, that's me, that's your neighbors, all of us. That's 70% of our nation's GDP comes from us spending money, whether it's on groceries or subscription services, whatever it is, right? And so, on the bright side, consumer spending did bump up in May, about 8.2%. Over the year, it's still down, obviously, because the level of spending is not there. But really, if we look at it, the most hard hit area is, which makes sense, is going to be service industries. People are still buying things. All right, they're buying goods. They're going on Amazon now and they're purchasing things. They're even buying Whole Foods and having it delivered, or DoorDash. You can still get your favorite restaurant's food. You're just not going there. And so the service industries are really the ones that are having the hard time right now. But really, on the bright side of this is that people are still spending money. Now, they're not necessarily spending as much money, say, as if everything was open back up and Corona was never a thing, right? But at the same time, they're still spending money. But we are starting to see kind of these trends where, yes, people do have money, which is a little bit odd for a recession, right? But we'll get into that here in a second when we talk about jobs and unemployment. But people do have money and they are spending it, but they're also tending to actually save at the same time. So we're seeing things like savings account balances increase, but at the same time, not a total stop in spending, which is typical of what you would normally see in a recession.
Yeah, I think anecdotally too, that's what Jeremy and I have seen as well, is that people are not spending as much as and this is just our clients, they're not spending as much as they normally would. Many people have called us up and said, hey, stop my monthly withdrawal from my investments. or they're telling us they're going to put off purchases where they were going to buy a new car. Some people have delayed retirements. They were going to actually, now they're going to wait until next year or the year after that to retire. So a lot of different choices that people have made. Certainly people aren't traveling. That's probably the big one for, at least for our retired clients. Many of them are used to running around the world and enjoying stuff, and hopefully we'll all be able to do that soon. But yeah, definitely been a very uneven spending changes, and some industries have been impacted more than others, that's for sure.
Absolutely. And so, yeah, a lot of the questions I guess that we get is, you can see the market at that. You can see the NASDAQ at an all-time high. Literally yesterday it set an all-time high, and then it did it again today.
Yeah.
Technology is just booming right now. Leading the way. Again, the S&P 500 is about 80 points off of where it was at its all-time high back in February. And so, how is all this happening? So if we look at the U.S. jobs market, it's kind of an interesting scenario. So really, I'm going to use the quotation marks here. That May and June created 7.5 million new jobs. Really, it's more like regained. One thing that we're seeing, and you can see it on the chart, that gray bar that goes down the middle, there's two lines on there. The dark line indicates permanent job loss, so jobs that just went away, okay? The lighter line is temporary jobs that went away, so more like furloughs, things like that, where the employer says, hey, we just can't afford to pay you right now. We have every intention of hiring you back. We just need a little bit of time to work with this. And so if you look all the way to the far right, they have this on a pretty long timeline here, but all the way to the far right, that's 2020. And so you can see those temporary job losses are really where we're at. And so yes, the amount of unemployed is exorbitantly high right now, especially for where we've been and what we've gotten used to over the last 10 years, right? But overall, really, they do seem to be kind of that temporary nature, albeit permanent job losses are up about 1.8 million since February. And so at the beginning of this thing, a lot of people were kind of under the assumption, hey, we're trying this that we've never tried before. We're going to do a shutdown. And so they were viewing it as kind of a V-shaped recovery. So we see a very sharp drop in it. We'll see a very sharp jump back up. Now, for various reasons that we'll get to on the next slide, that actually really hasn't happened, okay? And so really, it's probably going to look, I think at this point, we're looking more at maybe a Nike swoosh, right? A big drop there and then kind of a slow and steady climb back up. But really, the unemployment numbers, I think, tell us a little bit more of the story here. And so the number of unemployed remains pretty high, right? So just under 20 million, I believe. But the thing that was really, I think, being portrayed in the media and really leveraged a lot was the fact that we've had 15 straight weeks of million-plus initial unemployment claims. And so how can that be the case while the market is doing so well? Well, that's kind of a combination of a couple factors here. Factor one is going to be the Paycheck Protection Program, okay? That was a big one where initially when COVID hit, the Fed stepped in, and we'll give them credit, all right? The Fed stepped in and they did it magnificently. They stepped up and said, hey, we are taking all these measures. We're going to do everything we can to help this out. So initially, Paycheck Protection Program stepped up. At the very least, that delayed a lot of companies from having to actually furlough employees, okay? That allowed a lot of companies to be able to just continue payroll, minimal services, whatever that looked like, but at least it paid off in the short term there. I think what they weren't expecting is how maybe long this was drawn out. I think everybody was expecting, especially with the Paycheck Protection Program, that the reopening maybe would have been a little bit more in full force right now. And so I think what we're seeing from that program is that instead of all of those jobs hitting right away and people being furloughed, it at least spread that out, okay, over a number of time. The other part is going to be the extra unemployment assistance from the federal government. That was $600 per week that people were getting. And if you're thinking about the people that were laid off, mostly service industry, a lot of lower paying income jobs, really these people found themselves and they said, okay, I'm going on unemployment. And then I think it probably took them a couple weeks to say, wow, I'm actually making more on unemployment than I was actually working. And so it's not that those jobs haven't come back. It's just that I think a lot of these people have been hanging out and saying, why do I need to go back to work when I'm making more just sitting at home right now, albeit temporary, I know, but pretty sure I can get my job back when this stuff runs out. Now, as of the printing of this slide, that was still in effect. However, as of the end of last week, that extra $600 per week on those unemployment benefits is gone. Okay, the government has not re-upped that yet. Of course, they are still in talks for that, but I think a lot of those people are going to start to feel the pinch in a very short amount of time frame. So we may very well see those unemployment numbers drop. But again, it's going to come down to kind of that government assistance. Kind of the other factor involved in that as well with self-employed unemployment, which this is definitely hurt as well. Kind of again, that service industry, a lot of those self-employed people would never been able to get that unemployment, but they added that in, and so a lot of self-employed people have been able to kind of take advantage of that. And so what that does is that has been playing into it. People have, yeah, they've been unemployed, but they have still had a disposable income. They have still been able to buy their groceries. A lot of them pay their bills, et cetera. And so we see the ramifications of that in the market, despite large jobless numbers, initial claims of unemployment, and 20 million people claiming that they are still unemployed. And so it's kind of a weird thing. It's not like a typical recession where people lose their jobs and they don't have an income, and so they're not able to buy things that they need to buy. It doesn't look like that at all.
Yeah, it was quite extraordinary. The unemployment rate down at 4%. We hadn't seen that. It was like a 60-year low, something like that. And we'll get there again. The predictions are that vaccine or no vaccine, either way, that we're going to get back there, but it's going to take a couple of years. The economists that I've been reading are predicting 2023 that we'll get down to that 4% number again. And so certainly that has an economic impact. Again, remember, as far as people having money in their pocket to spend, that's most of the economy is funded just on us being able to spend that money.
Absolutely. Yeah, and so the flip side to that then, or I guess in addition, is we always talk about the fundamentals. As finance guys, Josh and I are always looking at the fundamentals. Why is a company overvalued? Why would we buy an overvalued company? Is it fairly valued? Where are the good buy situations at, et cetera? And so if we look at the valuation, I'm sure you've heard Josh say in the past, the stock market is constantly looking forward, right? It's trying to look forward. It's trying to figure out what's going to happen next. If we kind of look at what's happening in the market now, we can see, I guess we'd call it rose-colored binoculars. So rose-colored glasses, yeah, they let you look at it in a nice fashion. You're positive, but you can only see so far with glasses. With binoculars, you can see quite a bit further, which is what we're really looking at. Is with this current market, we're seeing a lot of investors just looking way further ahead. They're almost saying, we already know the second quarter is going to be terrible. We're in the middle of earnings season right now, and so we're seeing a lot of that stuff come in as we speak. But I think at this point, the majority of investors are looking well past that and saying, hey, we already know, we're expecting the worst on this, and we're already looking past it. And so they're already looking past that and saying, where is this going to really improve? We're looking at medical improvements and saying, we know that there's a vaccine coming. Do we know that it's going to work really well? No. Do we know when it's going to happen? No. But we're fairly certain that it's going to come and it's going to do good things. And so it's a little odd that the market is looking at far out, but also I think that it is taking into account a lot of things and saying, hey, Valuations do move with interest rates as well. And the Fed just came out, what was that, late last week, early this week, where he came out and said, yeah, we're not touching rates. Okay, we're just going to leave them low, and we're probably going to leave them low for a while. And so that does great things for valuations, right? It allows those PE ratios to stay at that high level. And if we look at earnings, which really is what it comes down to, right? That's where valuations come from. What's the price of it? Are the earnings there to back it up? That's ultimately where all of this comes down. Now, what a lot of us don't realize is that, yeah, 2017, 2018, those were great years, right? Earnings growth in 2019 was actually kind of pathetic. It was pretty bad. It was pretty low. I think we had, ever since, that whole 10 years leading up to maybe this last year or this year, we had been on such a bull market that I think a lot of us had kind of forgotten, what it's like. What does volatility feel like? What's normal? And so 2019 was kind of bad. There again, at the time of writing this, it was expected that earnings would drop 22% overall in 2020, and 44% decline expected in the second quarter. Now, as of today, well, like I said, we're right in the middle of earnings season, and so a lot of these companies are coming out and they're reporting their second quarter earnings. And oddly enough, many of these companies are coming back with better than expected results. Even some of them are positive, whereas everybody was expecting negative. So at this point, with what we know now versus when this slide was written, I think that 44% decline is probably a worst case scenario. It might be a little bit rosier, which kind of goes to that last slide, right? Everybody's looking out into the future, trying to paint that rosy picture, and maybe it's not completely unfounded. And so, and again, I think Josh just said this, improvement in later years, 2021, 2020, things are really starting to turn around. But again, a lot of that's going to depend on, what happens medically. But really, investors seem to be kind of looking past that slowdown. So, and of course, that doesn't take into account the unknown unknowns, right? Like COVID or a second resurgence. It's just with what we know now. I mean, we've gone through, COVID and murder hornets and, coin shortage, Chinese seed packets. I don't know that anyone would be surprised necessarily if, aliens show up and Bigfoot walks out. You never know. The way this year's been going, I don't think we might be very surprised with that.
Yeah.
But
Does anybody feel like you're living in a movie right now?
I kind of wish we could take a poll and say, hey, where's your bet? What's
Yeah.
going to happen in the second half of the year? Who knows? Who knows really?
Yeah,
But
absolutely.
yeah.
Yeah. All right, risk analysis. So, there's five big risks that we kind of see, and again, these are the known unknowns, right? These are the things that we're not sure exactly what's going to happen, but they're the things that we're kind of aware of, and I think you should be too. It's kind of like if you have a beautiful sunny day, which most of the time we do here in Colorado, but there's some clouds. There's always some kind of suspect clouds here and there, and they might be way off in the distance, but sometimes they end up becoming a really big deal, like coronavirus. Most of the time, if you think back to all the other viruses, the Zika virus and SARS and all these other ones, not to say that people weren't impacted on it, but to a large extent, we weren't here, at least in the US. I mean, certainly we weren't globally. We didn't see the global impact like coronavirus. So some of these things may not become a big deal, but they could be, certainly. And if you're wondering, well, what could mess all this up? What could make things worse than what we're expecting? These certainly would be it. One of those would be a pandemic resurgence, and some people would say, well, yeah, we're seeing that right now. I think there's been some ebb and flow to that. A big thing will be as schools open back up to some extent, at least. I think they're all trying to. For the schools that are opening up, that'll be interesting to see what happens if there ends up being a big resurgence because of that, and if schools end up shutting down and opening and going back and forth. So yeah, I think we're going to see a lot of ebb and flow. That's not going to just be a one-time, oh, there's a vaccine and so it disappears. Not going to happen. I think we're going to be living with things that are permanent, and also things that will not go back to normal, whatever that looks like, for quite some time. So, if there's no medical breakthrough, and I think there already has been on the therapeutic side, but I think what everybody is wondering is, okay, there's all these companies competing and coming up with a vaccine, and many are claiming they've got one and it works, and the government's throwing lots of money at it. Well, what if it's not though? What if it ends up not working, or what if it was a vaccine that wasn't appropriately tested and it ends up killing a bunch of people? We hope that doesn't happen, but it certainly could, and that would set things back quite a ways. Because I think in the market, I think there is some factor of it being baked into the market prices right now that, hey, a vaccine's coming, that we do kind of see an end to this. I would say I wouldn't be banking on that as much as I would say that we're coming kind of getting to a new normal, and we're figuring out, and companies are certainly figuring out how to operate in this kind of an environment. And certainly business owners should not be baking that into their business plan that, hey, by Q1, everything is going to be better or back to normal and we'll be able to just open back up. I think that would be a big mistake. I think everybody should be operating right now as if this is going to continue. And when the vaccine comes, if it comes, then that's great. That'll just be gravy on top of everything else. So certainly fiscal response, and I know this is being debated right now in Congress and with the president trying to figure out some type of additional fiscal stimulus that'll end up being pumped into the economy. Many different ideas on that. What we're hearing, at least as of today, is that they're very far apart. The two parties are very far apart on an actual solution. And of course, as we're coming up to elections here, really in just a few short months, there's a lot of politics being played with this, certainly on both sides. And who knows, it is possible that there won't be any fiscal response until after the election, because certainly there could be some factor of each side kind of hijacking the other side and trying to use it to score political points. We'll hope that doesn't happen, but it's possible that we won't see any additional fiscal response here until next year, until 2021. So stay tuned on that. The cooperative spirit that was happening in the spring, certainly when all this started, doesn't seem to be playing out right now. But the other factor, though, that I think if at least if it was me, and I'm not running for public office, don't worry, never plan to, but if I was, certainly, that would be a big factor, is that if you're running around campaigning, you want to be able to say, hey, we did this, I did this, I voted for this bill. So there is likely to be some kind of response. I'd put my money on that. There's going to be some legislation so everybody can go back to their constituents and say, hey, we passed this big relief bill and it's going to help our local economy. Particular industries, certainly there's some industries like cruise lines, airlines, energy companies, financial institutions. There are sectors that have been really impacted in a very uneven way. Certainly a lot of others, tech companies, healthcare companies, that are industries that have actually probably benefited in a lot of ways. So it could be for some period of time that we're going to end up with a period of time where a lot of these industries just can't function like they normally would. And unless there's other PPP loans or things like that come out, there could be some delayed bankruptcies here of additional companies that end up going out. I just heard the stat the other day that 15,000 restaurants have already closed permanently throughout the country, and in other words, they have no plans to reopen. So yeah, we'll end up seeing those things play out. Again, businesses, if they're really adaptable, they're really flexible, they'll be able to make those adjustments. And then of course, China is a big factor. Because they're the second largest country in the world, second to us, and they're saying within the next decade they may end up surpassing us. And that's part of the debate, is really how much influence and power does China have in the world? And every country has a little bit different response to that. So certainly there's a big power grab that's happening right now. I think whatever political side you're on, I think you would agree with that there's a big power grab going on in China. And again, every country is kind of figuring out how they're going to adapt to that and and try to keep some unsavory things from happening. So long run predictions, again, it's a different world. Clearly things are not ever going to go back to the way they were before. And some people would say, you know what, that's okay. Maybe there's been some good changes. There've been some good things. I think for many people who never would have had the opportunity to work at home, either part-time or full-time, they've got the opportunity now. Could have been an opportunity to spend more time with your kids. I thought as weird as it was, I thought it was kind of fun in a way, really in the spring with the kids at home every day. I got to eat lunch with them. It's probably not going to happen again. It's probably a once in a lifetime opportunity. And I think a lot of the things that we normally take for granted, the freedom to travel, the freedom to go to church, the freedom to do a lot of stuff that we normally would do, hopefully all of us walk forward when we return to things kind of opening back up permanently. Hopefully none of us walk forward and forget about it. Hopefully we don't go back and take those things for granted again. So certainly, technology has been a huge accelerator, and it has been over decades, but now even more so as it's been forced. Certainly, there's going to be a lot more innovation that ends up coming, and many of you are involved in that. For many of you are working at tech companies and biotech companies. Many of you are involved in the future and really building out what's going to be solutions for us as individuals and businesses. Low interest rates, that's going to be here for quite some time. The Federal Reserve is going to be much more concerned about getting the economy going again, and certainly that would be a way to start hitting the brakes, would be raising interest rates. So for those of you who have refinanced your mortgages and so forth, that's probably a good thing. For those of you who have a bunch of money in cash and savings and so forth, probably not real happy about that as your interest rates are so low. We should talk about that. If your cash levels are too high, of course, we should talk about some solutions there, because that's not going to change anytime soon. And then deurbanization, again, I just mentioned the telecommuting thing and the fact that a lot of companies really have been encouraging workers, even big tech companies like Google had been building out these big elaborate campuses with gourmet chef lunchrooms that were paid for, and they'd take your cleaners and bus you to work and all kinds of stuff. Well, now really by and large, people have been at home, or many people are still at home at this point. And for companies that are going to allow telecommuting permanently, some people that are in San Francisco or New York City, places that are just normally extremely expensive places to live, there's more than likely going to be some exit. If people know that they could go move to the middle of Kansas or someplace much cheaper maybe than where they had been before, that could be a big quality of life enhancer. We actually could see quite a bit of deurbanization because of that, as well as some of the social unrest that we've seen this year because of the riots and protests and so forth. Some people may want to go to a different environment, really where maybe small town America starts to look kind of good. So I'm from Iowa, by the way. So I remember some of that. I'm not going back to Iowa, I'm staying in Colorado, but yeah, I could see some of that benefit. Certainly, there's been an amazing run here in the stock market. The whole point here is to know that risk always exists. We don't know when the next correction is coming. We don't know when the next recession is coming. We went through a large period of time, over 10 years, where we really didn't see much of a decline in the market. In fact, I don't think there was a single time that the market went down over 20% in that 10-year period. So it was really an extraordinary period of time, not usual, by the way. It's actually statistically every 3 to 4 years we see a bear market, which would be a 20% or more decline in the market. So some would say we're overdue. Maybe, yeah, I mean, statistically, maybe we were overdue. We didn't know why it would happen, why the correction would happen, but it certainly did. Thankfully, it didn't last that long, knock on wood. We certainly don't want to revisit some of those low points that we had seen earlier this year. My personal opinion is that it was overdone. The market corrected way too low for the circumstances. And so it certainly is something that, we're certainly watching the market levels, but we think the market is not drastically overvalued right now or in some big bubble. So, and then in the end, we're just optimistic that we're going to figure out the problems like we do. I think as a society, the world, that's the story of history, is that stuff happens. Sometimes bad stuff happens, really bad stuff happens, but everybody figures it out and we end up moving on. And in a lot of cases, we end up making the world a better place because of that. So maybe it's just us being eternal optimists, but I think that's the story of history. For those of you who are students of history and students of the market, and really the advancements that we've seen over the last couple hundred years in the world, pretty extraordinary. And certainly for anybody who goes out there and starts poking around and looking at where the future is going, I think it's going to knock our socks off. Some things we can't even conceive of right now that'll certainly help make our lives better and help the market continue to advance, because that's just a reflection. I think the stock market is just a reflection of people being really creative. And ultimately, I think we all get to play a part in that. So with that, again, we want to take some time here for questions at the end. And really, we're not on a deadline. We can stick around, but we do want to honor people's time. If you need to pop off at 5 o'clock, certainly feel free to do that. We are going to have a recording of this available, and it'll be on our YouTube channel once we get approval from our compliance folks, hopefully here within the next week or so. That being said, your email questions can go to jeremy@keystonefinancial.com for those of you who are on live. And if you're listening to this after the fact, certainly listen to all the questions. And if yours doesn't get answered, then please just email us after the fact at jeremy@keystonefinancial.com or josh@keystonefinancial.com. So with that being said, what do we got, Jeremy?
So we've had a handful of questions come in, and oddly enough, they are all around one topic. And that topic, probably shouldn't be surprised at this, is what is the impact that we would think if of a Trump or a Biden win in November?
Well, I would say we kind of touched on this a little bit before. We think that politics is going to have less of an impact than it normally would during a presidential election year. And the reason for that is all the events, including the murder hornets, right? But if you think about all the things that are happening right now are just much larger, I think, than who's in office politically. There's a lot that can happen between now and then. I think there's probably some argument that if you had, and this isn't a prediction, but if you had an all-out, outright socialist push, I don't know that a lot of people are banking on that right now, but if it was just an outright socialist push to the left, then that could be really bad for the business environment. I would still go down and debate anybody any day that the best companies are the best ones that are adapting. It's one of those things like the survival of the fittest. That's kind of how the market is and the business world is. And one of the things that any company, including ours, has to contend with is that you've got government. You've got the government, and the government's going to make rules, and the government's going to change your tax rates. It might even shut you down temporarily and not let you do business like you normally do business. But the most adaptable businesses will be the ones that end up surviving and innovating and still surviving through that. So, but yeah, I've heard some strategists that have said if you saw like an outright, real like a legitimate socialist push, that you could see a big sell-off in the markets because of that. I don't know that there's a lot of prediction that that's going to happen necessarily. The market, by the way, likes gridlock. The market loves gridlock. In fact, if you look over the last 100 years or so, the market has tended to do the best during periods of gridlock when you've got a divided political situation between the president and each house of Congress. So, I guess if that's all we cared about was the market, we should all be banking on the fact that we want a good, divided political situation where nobody can really exert a huge amount of force one way or the other. But if that's what we see, I don't know that we're going to see a lot of massive change. I don't see that the market will react a lot to that. Right now, at least the predictions are that we would either continue forward with a Republican Senate, a Democratic House, and then kind of a toss-up right now on the presidential end. And there's certainly some debate about if it was a President Biden, how would he govern? Would he govern in a more moderate, Democrat fashion, or would it be more extreme? Who knows? There's so much that can change between now and then. And even within a presidency, certainly a lot could change. And it's not something that we're spending a lot of time worrying about as far as how portfolios are positioned.
Yeah, and I think to go along with that too is, short term, obviously, we could throw charts at you and statistics left and right that show in the long term that honestly, it really doesn't matter. Doesn't matter who gets voted in, who's in Congress. The market's going to do what the market's going to do. Short term, I think with the Democratic candidate being Joe Biden, I think that took a lot of the edge off of what was expected. If it was like a Bernie Sanders or an Elizabeth Warren who had won the Democratic nomination, you might see a little bit more apprehension, I think, in that. But I think the general idea, short term anyway, is that Biden coming kind of from that Obama camp and of that mind that was, quite honestly, from a Democratic standpoint, was actually pretty business friendly. I think that's the market's kind of taking that into account and not expecting big swings. Now, that's not to say that, if there is a Democratic shift, that there wouldn't be some volatility, here or there, that could definitely happen. But is a major sell-off is pretty unlikely. I think the bigger function of that, and like Josh was saying, is how that next president is going to govern. Mainly in line with, if we're looking long term, what are they going to do around national debt levels? Obviously, national debt has increased a lot lately, or more recently, I would say. Short term, we get that question a lot too, right? Is, hey, what are we going to do about the national debt? Short term, not a lot of implications going on that, but long term, absolutely, that's going to have some inflationary aspects, things that'll happen, and so that next president's going to have a lot to do with that, and how that starts to figure out. Well, I guess luckily the entire world's really in that same portion. I don't know a single nation that isn't having their national debt increase right now, better or worse, whatever that means, but it is an actual thing. And so I think that would long term play into it. But yeah, as Josh said, short term, I think the market's doing its best to kind of look past the election at this point, and so it's kind of priced in no matter what happens.
Yeah, I think the debt levels, although long term could be troubling if they stayed like this. If you look back to the 1940s and World War II, there was a massive increase in government spending to fund the war, and then things kind of tabled off after that point. Now, after the financial crisis, you would think, and we didn't do this, after the financial crisis, there was a huge amount of borrowing and stimulus and everything like that. And then after that, basically both political parties, Republican and Democrat, have spent like drunken sailors. And so our debt levels have gotten quite high. And then, of course, that's not even including some of the unfunded promises of the future, Social Security, Medicare, Medicaid, that we know have been issues. And the money isn't just sitting there in some pot of money. It's something that has to be funded out of payroll taxes and current spending, current resources. So.
Mm-hmm.
So, from a financial planning perspective, one thing to think about, and this isn't a tax seminar, but one thing to be thinking about is that historically we're at very low tax rates right now, both corporate and personal. So the political pendulum swings, and eventually it is going to swing the other way, and maybe it has to be able to fund some of the spending that we're doing right now. So one thing to think about, of course, is thinking about your own situation, and that if we have a tendency to be deferring taxes, which many of us have been conditioned to do, you might want to think about that a little bit, as far as actually recognizing some taxes now. If you think the tax rates will be lower now than in the future, for example, doing Roth conversions, it could be a time to start thinking about that if you haven't already. So, and then the other thing, I just wanted to kind of hit on the political stuff, because we're just being hammered on this every day, right? And it'll just get worse between now and the elections. Is, keep in mind that there's a lot that changes, and as a country, if you look historically, not even just recently, is we don't tend to like extremes. And when you do see elections, both Republican and Democrat, where there's just a super majority that ends up taking Congress and presidency, uh, there's almost always there's this massive swing back the other direction after a couple of years, especially if there was some overreach that ended up happening. And so, let's kind of play out that scenario and assume that there was a massive push to the left. And again, this is not a political commentary or saying what's right or wrong. So don't send us hate mail. Let's say November rolls around, and you have Biden win, and maybe there's just this huge leftward surge in the House and the Senate. It all depends on how they govern. Right. It's all going to depend on how they govern going forward. And if there's extreme policies, especially ones that maybe the average American wouldn't support, you're going to see this huge shift back the other way, almost certainly after a couple of years. And that's played out on both sides. We saw that happen with the Republicans back in the 2000s. There was a big surge that ended up winning an election, and it kind of came all the way back after a couple of years. So just keep that in mind. Jeremy mentioned it before. Is political predictions are not a very good way to manage a portfolio. So there's just not a lot of correlation, and the markets can function and have functioned really well under Republicans and Democrats, as well as done really poorly under both Republicans and Democrats. So I wouldn't be the thing that you kind of hang your hat on as far as the thing that you should be thinking about as far as your own risk tolerance and your own asset allocation. That is very individual, and it needs to be thought out long term, not just based off of what's happening in the day. If you had done that this year, can you imagine what kind of portfolio moves you would have made after the market was plummeting? Some people might say, well, this is just going to keep going down forever. And then you would have missed out on a massive surge as things came back. Same thing in the financial crisis, is there were predictions that the whole financial system was going to collapse. And I know people, unfortunately, who got out of the market at the time just thinking that, hey, I'm going to lose all my money if I don't get out. And then, of course, things finally did kind of burn out and it started getting better. So just recognize that nobody's ever been able to consistently time the market. Even Warren Buffett, even the smartest people, the wisest people of investors cannot get it right every single time. The smartest thing is to really make those fundamental decisions as far as your own risk and your own asset allocation. And certainly we're here to help you stay on track with that. So what other questions, Jeremy?
Well, I know that we're at time, but we do have one last really important question, and it's for you specifically. Sure. And it's how are Sarah and the new baby?
Thank you. I know we should have put a slide in with the photo.
I was thinking that too. We should have put a slide of Cameron on there.
Yeah, exactly. Yeah, you guys will have to connect to our social media. And of course, this is our plug for social media now, so you can see pictures of Cameron. But that is important to stay connected to us, of course. So jump on there. But they're doing great. Cameron just hit 3 months old here a couple of days ago. So everybody's happy and healthy, and yeah, it's definitely been a fun season, and we've actually gotten to spend more time with her because of coronavirus. So we've actually gotten to spend more time with her. So again, there are some good things that end up coming from it. So, and then kind of to wrap up, I did want to hit a couple of points before some of you have to leave here. Keep an eye out. We're actually coming up on our 10th anniversary, our 10th birthday, Keystone Financial Services here in December, later on in the year. So we're going to have a number of ways that we're able to be creative and celebrate that. So kind of keep an eye out for that. Make sure you're plugged into our social media. You probably got our emails. That's how you got this invitation. So just make sure you're getting our stuff. And again, tune into our social media, because that is a way that we're increasingly using, including Cameron photos, making sure that you're able to connect with us, not just on business stuff, but also that we know we can share in each other's lives. And we mentioned that at the beginning, that's really the best part about this business, I think, is the relationships that we get to have and the impact that we're able to have on you. So certainly let us know if there's anything else that comes up that we need to discuss. Any individual stuff, of course, let's talk individually about your situation or your friend or family that might need help with this stuff. We really want to be the antidote to all the craziness out there in the world and all the stuff that the media is trying to scare us with. Although it can be morbidly fascinating, it's not terribly useful when it comes to financial planning decisions. So we want to make sure that we're here to support you and be that voice of sanity, hopefully in a crazy world. So also watch out for our podcast, our long-awaited podcast, Wiser Financial Advisor, is coming out very soon. So watch out for that. We should be having some the first episodes drop here within the next week or two. So look forward to that. Another way that you're able to get some insights from kind of what our thoughts are, some of the things that we've been talking with individually with clients. Also a great way to be able to plug in some of the people that you care about, again, coworkers, friends, family, that really could use some help or really would like to get to know us better. So with that being said, thank you all. Thanks for attending today. Thanks for your support in your business, of course, and your friendship. Let us know if there's anything that we can help with, and we hope you have a wonderful week. God bless. Yeah, take care.